Welcome to the Daily Update, where I'll go over the action in the market for Monday, May 15th, and then we'll see how things look for Tuesday, May 16th. We had a bit of an up day. Wasn't really strong. It was pretty choppy overall. It hasn't really changed our technical picture all that much. We're still mixed overall, and I know you don't really like that. I know a lot of folks that listen to these are trend traders. Some of you may take advantage of the sideways movement, but it's really frustrating. It's like either we're going up or we're going down. Something could be said for the fact that we might be consolidating by going sideways. This could be a form of a low. Now, we need a lot more evidence than just that thought to come into our mind, but it is something to keep in the back of our mind. Before I get started, I do have a supplemental video that you're welcome to watch. Those charts in that video don't change all that much, and they haven't changed in a week since I posted that video, so it's still not out of date, and I'm watching all of those charts each day. I do have a PDF that you can get in the description for either the video or the podcast. I do have a private Facebook group, and you're welcome to join that. I don't have a poll that's posted this week. So let's go back and talk about what happened. We had a higher open. It looked like, okay, here we go. We're going to have a good, solid Monday. But this led to quick selling. Prices then went down to the unchanged level, down below the daily pivot at 41.22. They finally found support at 41.10. We didn't hit an S level or an R level in the entire session. As the day went on, prices rebounded back up to the daily pivot. We went positive. Then we hit resistance at 41.40. Prices then fell back down to the unchanged level, which is that built-in support level, before rebounding back up to close at 41.36. We were up 0.3% on below average volume, and the technicals are still mixed overall. We're just chopping sideways because of this inflation and interest rate scenario. Now, in the short term, we have this debt ceiling issue that's coming into the picture, and the market may be reacting to that. We're wondering if we're going to get any more banking information that comes out. What are some comments that we can make? The 4,100 level still has become pretty significant for support. There is a scheduled meeting on Tuesday between the president and congressional leaders to talk about the debt ceiling. The financial sector and the bank stocks actually had a pretty good day on Monday. The dollar was down and interest rates were up. The 10 to the 5 and the 30 to the 5 have gone back to being normal. I may take those off this list, where the ones that we watch closely are the 10 to the 2-year and the 10 to the 3-month. Those are still inverted. Sentiment is positive at 59, where it had been at 57. Our trend, nothing's really changing here. It's positive, but it's weakening because the ADX is below its moving average, and both of those are below 20. I've kept our bias at mixed and our momentum at mixed. We're not really seeing a lot of conviction. Economic reports that came out. We had the Empire State Manufacturing Survey. It dropped to minus 31.8, where they expected just a mere down 1.8. Last time it came out, it was at 10.8. Under zero shows a contraction in the area. So this is pretty negative overall. Looking at the FactSet blog post, the headline says there were fewer S&P 500 companies that are bringing up the word inflation when they do their conference calls after their earnings are released. Here's a chart showing that it is decreasing. Now, we're not done with earnings season yet, but we are seeing this really starting to drop off. Looking at Game of Trades, had a pretty interesting chart here. This is the leading economic indicator, or LEI, and that will come out on Thursday. That's the black line, and it has really been declining. We see that the red line, which is the year-over-year change in the S&P, it's been going up. So we're seeing them going in opposite directions. If you look at this over a period of time, they tend to go in the same overall direction. So what's going to give here? Is the LEI going to turn and go back up, or are stocks going to start to come back down? Also, Shivaco Capital had an interesting chart. Everybody's all worried about this Fed pause and more of a dovish stance on interest rates. What typically happens when they do that? This blue line is the average, and you can see over a period of time where we tend to decline overall. It doesn't produce a lot of longer-term strength. Think about the logic behind this. If the Fed comes in and says, we're going to pause rates now, even though they may not say it exactly like that, what's going on in the economy to make them do that? Employment is probably looking bad. Growth is looking bad. The economy is pretty weak. And that feeds over into stocks because their earnings are less and their profits are less. So that doesn't justify stock prices going up. So we may get some kind of a short-term relief rally after this happens, since it's been over a year now that the market's been waiting for this. But is that going to lead to a longer-term upward movement? Now, it doesn't mean that's not going to happen. We just want to be aware that it doesn't always happen when you take it in the context of what's happening in the economy. Isabel Net charts. Looking over here on the right, it says that the Fed keeps hiking until the Fed funds rate is greater than the CPI is. We are at that level now. CPI is at 4.9, where the Fed funds rate is at 4.25. Does that mean they're going to consider pausing rate hikes? Looking at some earnings revisions, this is showing some improvement on this chart. We're coming back up to the zero line where we had been declining overall. The authorization for buybacks still is pretty healthy. These are companies that also buy back their own stock. If they thought the market was going to fall apart and they could buy their own stock at a lower price, would they be doing it now? So the fact that this is pretty strong is still pretty positive overall. However, just because they announced that they're going to do this, that they're actually going to do it in practice. Then looking at price reaction after an earnings report comes out, the upside tends to be 0.3%. The downside is minus 2.4%. That kind of goes in line with in yesterday's video. I talked about the FactSet blog post with how stocks react after their earnings reports come out. One area to keep an eye on is California, New York, and Massachusetts, because their initial jobless claims are coming in a lot stronger than the rest of the country. There's a lot of companies there. There's a lot of insurance, financial companies, medical companies. And if they're starting to show some weakness, is that going to feed over into the rest of the country? Then we're seeing gold getting back in favor with a lot of folks right now. So we're seeing an increase in the speculative positions. Then getting into our charts, where this shows that we did have a higher open, but we immediately saw some selling going into strength, where we came down to the unchanged level. We went down below the daily pivot. We hit some support at 41.10, bounced up off of that, came back above the daily pivot, went positive, went all the way up to 41.40 before we came back down to the unchanged level, and then saw some strength going into the close. Here's the intraday chart with the SPY, where we had seen some weakness in the initial overnight session. That was in Friday evening. And then when things opened up Sunday afternoon and evening, they looked a lot more positive, but then we gave all that up by the time the market opened. Currently, they're trailing off just a little bit in the early hours of the overnight session. Growth continues to outperform value. And here is an intraday chart showing growth versus value. When this ratio is going up, growth is leading. When it's going down, that means value is leading. Value really was up stronger in Monday's session. Even though growth was up, it was only up 0.14%, where value was up more. It was also up more with the mid caps and the small caps. Looking at sentiment, our Ulcer Index still suggests there's not a lot of fear. The VIX ticked up just slightly on the line chart as well as the bar chart, but there's still an awful lot of complacency in the market. The VIX of the VIX is calming down just a little bit. We do have options expiration this week, so this chart may show a pickup in volatility as we get closer to Friday. Then on the top, we have the MOVE Index, which measures the volatility of bonds. And then on the bottom is the volatility of stocks. We're just about at the midpoint with the MOVE Index. The SKU Index, where it looks at out-of-the-money options, both above and below current price, we ticked up just slightly, but we're not giving an extreme reading right now. This may go up as we get closer to options expiration. The equity put call ratio is not generating a new signal right now. Our fear gauge that we look at did tick up just a little bit, where this other fear gauge actually ticked down slightly. And folks are still favoring a risk-off type of posture, meaning they're getting out of stocks and getting into bonds. Advanced decline line studies, we ticked up based on price as well as volume. But in the short term, we're seeing a bit of a negative divergence here. And longer term, we're also seeing that negative divergence. The new highs are not really expanding as the market has been showing some improvement. Our 5 period continues to decline, as does our 10 period. The advanced decline ratio, we're above 0 with the red line, but still below 0 with the blue line. Accumulation distribution still remains positive. We're above an advancing moving average. Then looking at the cumulative advanced decline line as well as the regular advanced decline line, we're still seeing this negative divergence, even though there was some improvement on Monday. Looking at common stocks, we're still seeing this longer-term negative divergence. Looking at our broad range, the NYSE is coming back up to its moving average. The S&P did show some improvement. The mid caps are coming back up to the moving average. The small caps showed some improvement, but we're still below a declining moving average. Looking at our trend, no real change in this chart. The ADX is below its moving average. It's trying to turn back up, but it hasn't crossed the moving average yet. The green line is on top, but it is declining. Then volume continues to drop off. Looking at our short-term analysis, we haven't really done anything on the daily chart. We're just chopping more or less sideways, a little bit above and below this pivot level. We are a little bit above the 20-period simple moving average, so in the short term, that's more positive. The stochastics were above 50 and advancing in the short term. Intermediate term, we're above 50. We're still declining in the long term. The force index is slightly above zero, so that's positive. Now some intermediate term charts, the balance of power did show some improvement, but is still below the dashed line. We're right in between the double and triple exponential moving averages. And the go, no-go system is more positive with the darker blue bars. The TTM squeeze is showing a little bit of improvement, but is still negative overall. Our Arun continues to be negative with the oscillator below zero. The PPO studies, long and intermediate term, were still positive. We're turning back slightly positive in the short term. The McClellan oscillator, still working off of this longer-term negative divergence. On a short-term basis, we turn back up, but we're still below zero. Then looking at the NYSE McClellan oscillator, we also showed some improvement, but we're below zero, and also seeing this longer-term negative divergence. The Swellen trading oscillator based on price ticked up, but it's still below zero. We did see a decline based on volume. The Elder Impulse system for the S&P is switched back to positive. The PMO remains negative, and it's declining based on price and volume. In our PMO study, we're still seeing this negative divergence in the longer term. We're turning back up slightly with the percent of PMOs that are rising. We turn back up just a little bit with the buy signals as well as the PMOs that are above zero. The parabolic SAR system, however, still remains negative. We're watching the slope oscillator. Is it starting to cross back above its moving average? It's the most sensitive oscillator that we have, where all of the other oscillators continue to be negative. We're looking a little bit more positive with the BPI. We were able to cross back above 50. Anything above 50 is positive, below 50 is negative. But longer term, we're seeing a negative divergence between this indicator and what the S&P has been doing. Broader range bullish percent index, we're still below 50 and we declined slightly, so that is negative. We're above all the plotted moving averages in our moving average tree. The Chaikin money flow continues to hold up fairly well, so that's positive. And the Chaikin oscillator is also showing some underneath strength. The money flow, even though it's below 50, that's negative. It is showing some improvement, and we're below the declining moving average with our on-balance volume. The ultimate oscillator is showing some strength, though, so that's positive. And our vortex is turned up with the green line, so that is positive. The summation index based on price is declining and based on volume, and we're below zero. Longer term, we're also seeing a negative divergence. And then looking at our 250 period moving averages, those stocks that are above either of those continue to show a negative divergence. Looking at some Fibonacci and line studies, we're still below this 4170 level. We closed at 4136, and we're slightly above this 100% retracement level at 4123, where we closed at 4136. Longer term, we have some upper resistance at 4156, which is 20 points away from current prices. And then longer term, if we start to fall, we're still looking at support at the 4020 level. And then this I haven't shown in a while. This is a 20-period simple moving average of the open, high, low, and close. It just shows that our trading ranges have been inside of all these different moving averages. Then we do have an end of the cycle coming up on Friday. That will be May 19th. So we'll be seeing if that has an impact on switching things in the market. When looking at our 50-day cycle, this solid line here is based on a Commitment of Traders report and a blog post that I read, where they see a lot of support at the 4080 level. If we come down below 4100 and then below 4080, we'll really be watching to see if the selling does increase. Then we're also wondering if we go up, will we hit resistance at about 4200, looking at this downward sloping trend channel. Looking at our different charts, the Heikin Ashi remains pretty much sideways. The KG chart is still negative with the red line pointing down. The Renko is still positive, and the 3-line break is still positive. Looking at different indexes, the equal weight, even though it showed some improvement, is still underperforming the S&P 500. Looking at our new take on Dow theory, we're still above this blue line on the S&P, and we're breaking out slightly with the NASDAQ. Can this get some legs and still continue? The transports continue to underperform the Dow. The Dow is finding support at its 50-period moving average, and the diamonds have changed from being negative back over to neutral. The NASDAQ is breaking out above this red line, but we're hitting resistance at this R1 level. And we're getting a little bit close to the Fibonacci retracement level at 38.2%. Right now we're at 12,365 with the NASDAQ. This resistance level is at 12,427. Then this is a new chart put out by Shivako Capital where we have the S&P on top, but this is a cumulative measurement of the new highs minus the new lows in the NASDAQ. You can see a really solid negative divergence. Looking at the NASDAQ 100, we are showing a bit of improvement, but we're hitting this R1 level. And the Qs have switched back to positive for the Elder's Impulse system. And if we keep going up, we're looking at the 50% retracement level at 13,614. That's about 200 points away from current prices. On the weekly chart, the Qs remain positive. We're above this anchored moving average going back to the all-time high. And the small caps, if you look at just the index, yes, we've had a recent death cross and it's showing some weakness even though it bounced up on Monday. But I have another chart to show you. The Russell chart is showing that we did cross back above 50 with the RSI and the MACD is trying to go positive. The small caps continue to underperform the S&P 500. And then the small caps Elder Impulse system have changed back to positive. This is a new chart, and this was put out by Tom Bowley at stockcharts.com. I just recreated these charts. When we look at the small caps, and yes, they have really been underperforming, especially since the beginning of February. But when you take a ratio of the growth versus value, look at what is happening here. This is really showing some strength. It chopped sideways for a while, but this is strength that we're not seeing in the index. This is more underlying. Now think about the smart money. They're the ones getting into this. This is what they do. They buy things secretly and they sell things secretly. If they thought that we were going to just fall off a cliff and that this negative divergence that we're seeing between small caps and the S&P 500 was going to lead to weakness, would they be getting into growth stocks? No. They would be getting out of growth stocks and getting into value stocks, making this ratio go down. But we're seeing a lot of strength in this ratio right now. So it's under the surface. It's not really having a direct impact on the S&P 500, but it could be some internal strength that eventually helps the market to go higher. Then looking at the mid caps, also the index itself showing a recent death cross and some weakness. And the mid caps have switched back to positive for the Elder's Impulse system. And then here's this chart as well, showing the same thing. The index has been showing a lot of weakness for the mid caps. But when we look at the ratio between growth and value, this is showing an awful lot of strength. So we want to keep this tucked back in the back of our minds. The micro caps were up over 1% and well off of their 52-week low. The home builders were chopping sideways with the S&P. We're breaking out a little bit with the ETF for the home builders. So the ratio is holding up quite well and the relationship is showing some improvement. We are seeing some negative divergences here. And I just drew these lines on here. They're not anything magical. We have been holding up a lot better with the Dow. Well, we're seeing some negative divergences with the transports and some divergences here with the utilities. That could be longer term weakness. Looking at the banks, they were up on Monday. The financial sector was up 0.82%. And the financials compared to the S&P did bounce slightly, but they're still strongly negative. And the regional banking ETF did bounce up compared to the financial sector, but is still in an overall downtrend. Looking at our interest rate studies, and this is the topic of what I covered in the supplemental video. The reason I say the charts are not really outdated right now is because we continue to be right in the middle of this rainbow. If things start looking better, this ratio will go up. If things start looking worse, this ratio will go down. Nothing has been decided, at least yet. Looking at bonds, they're still looking at a pretty strong spread between the S&P and the TLT, which is the long-term bond ETF. Yields were up and bond prices were down on Monday. And then looking at the 1 to 3 month T-bill, which we could say is cash, more or less, and then comparing that out further to other maturities, when this ratio is going down, that typically is positive for the market, and it suggests that the Fed is either pausing, if not cutting interest rates, so we want to keep an eye on this. And this is an interesting chart as well, and this might have to do with the debt ceiling issue, where we take the 1 month yield and then subtract the 3 month yield, where we had really gone extreme negative here, and now we're going extreme positive and we're starting to come back down. Our long-term analysis, the special K, is starting to come back down after coming up to the red line. Looking at our long-term trend, the MACD is still holding up, suggesting that this breakout above the trend line is currently legitimate. An update of our possible positive scenarios, the Q's turned down just a little bit compared to the S&P. Discretionary is not showing a lot of strength right now, and large cap growth turned down just a little bit compared to large cap value. And then this is just a variation of the charts that I showed you where we take the growth to value ratios. The large caps are still holding up. We're seeing a bit of a breakout here with the mid caps as well as the small caps. The stocks that are above their 200-day simple moving average that are inside the S&P 500 were pretty much at the midpoint. The S&P continues to underperform the utilities ratio. And looking broader at the Amex, NASDAQ, and NYSE, and then taking a 5-period moving average of their highs minus the lows, we continue to be negative. Then a 50-period exponential moving average of the new highs, new lows, we're turning down, but we're still positive. The indicator is dropping just slightly, but it is still positive as well. So what's our outlook for Tuesday? Earnings season is continuing, but we're kind of getting near the end there. The technicals are mixed. Unless you like to do sideways type strategies, you're probably pretty frustrated right now. As far as the economic reports, the biggie on Tuesday will be retail sales, industrial production and capacity utilization will be coming out, business inventories, and then the NAHB housing market index. We're going to be getting a lot of real estate information this week. And then the whole list of geopolitical events. The debt ceiling is more in the short-term overall focus of the market, but then we're also worried about inflation and interest rates. And then any more banking information. Then here is a schedule for the entire week of different speeches that members of the Fed are giving. The one in blue, we already gave that speech. That was on Monday. The more interesting one will likely be on Friday when Jerome Powell's going to sit down with his old pal Ben Bernanke, and they're just going to talk about stuff. Well, the markets may try to read something into what is said. Now, another one that could be important is on Tuesday and Thursday, where Vice Chair Barr is going to be testifying before the House on Tuesday and then the Senate on Thursday. And if he starts dancing on tables and saying this ought to be so and this is what we need to do, that could have an impact on the market. Looking at our Stock Traders Almanac statistics for Tuesday, May 16th, we're neutral to positive with both the Dow and the S&P 500, where we tend to be more positive with the NASDAQ. It's up 61.9% of the time. And then we tend to be positive in the month of May. And then we're on the 12th trading day for May. The green dashed line, which is during a pre-election year, that's slightly positive. So our scenarios, hard to go with the down one right now because our technicals are mixed unless you really want to capitalize on those negative divergences. But we don't have any real confirmation on other charts that those divergences are starting to lead to weakness. So it's hard to go with the up one because we're mixed and we do have a lot of negative divergences. So we default back to the neutral or sideways trend because the ADX, it's weakening, it's below its moving average, both are below 20. The green line is on top, but it is declining. So the warning signs, and I feel like a broken record with this. There are numerous negative divergences that are all coming together. The VIX is still showing a lot of complacency. The S&P is underperforming utilities. We're still in a risk-off posture. Small caps are underperforming unless you look at the growth small caps. And mid caps have generated a recent death cross in the index unless you look at the growth part of the mid caps. And earnings season continues, but it's starting to come to an end. On the positive side, we still have seasonality and setups that apply to the whole year that remain positive. Lower price levels may provide support. We're looking at the 4,100 level. If we drop below that at 4,080, if we drop below that, we're looking at the 4,020 level. The NASDAQ may be breaking out above resistance. It's showing some improvement, but we want to see follow through with this. So our conclusion, The S&P is mixed, not trending, and showing negative divergences. That's the same as what I had for Monday. Short term we're mixed, intermediate term we're mixed, long term, as long as we're above that 200-day simple moving average, we remain positive. So thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.